Have you ever noticed that one trade policy can send shockwaves throughout entire industries? Today, I'm breaking down how tariffs are shaking up the stock market, highlighting the sectors that are hit the hardest, and those that remain pretty safe. I'm Jalen, and if you're new here, hit subscribe for clear, no-nonsense financial insights. In today's video, we're diving into the impacts of tariffs in the stock market. We'll explore what industries like tech, steel, and agriculture are more vulnerable to these trade policies. Whether you're an experienced investor or just starting out, understanding these dynamics can help you protect your portfolio and seize opportunities when markets shift. Let's jump in. First, let's break down what tariffs are. Simply put, tariffs are taxes imposed on imported goods. Governments use them to protect domestic industries, negotiate better trade terms, or generate more revenue. When tariffs go up, imported products can become more expensive, which can ripple through the economy. Companies that rely on materials or products face higher costs, and those costs often get passed on to consumers. This increased cost creates uncertainty and can lead to market volatility. Now, let's talk about which sectors feel the brunt of tariffs and why. Industries like steel and aluminum are classic examples. Tariffs on these raw materials raise production costs for companies that use them to manufacture anything from cars to construction material. When costs rise, profit margins can shrink and stock prices can suffer. The tech sector is another vulnerable area, especially companies that rely on global supply chains. When tariffs are imposed on components or finished goods, it can disrupt supply chains, increase costs, and even slow down innovation. Even though tech is known for rapid growth, these added costs can dampen investor sentiment. Agriculture is also highly sensitive to tariffs. Farmers and food producers often export their goods, and tariffs imposed by trading partners can limit market access. In turn, domestic producers may struggle with lower prices and reduced demand, impacting their profitability. Trade wars have historically hit agriculture stocks hard, as seen during past US-China disputes. The automotive industry is affected too, particularly when tariffs target imported auto parts. Cars are built on a global scale, and increased costs can force manufacturers to either absorb the costs or raise the price. Both scenarios can lead to reduced demand. But on the flip side, some sectors tend to be more resilient or even benefit from these protectionist policies. Sectors like consumer staples and utilities often fare better during high tariffs. These industries provide essential service and products that people need regardless of economic conditions. Their demand remains relatively stable, which makes them attractive to investors during times of uncertainty. Healthcare is another sector that tends to be less impacted by trade policies. Since people prioritize health no matter what, companies in this field often have more predictable revenues, even when tariffs disrupt other parts of the economy. Understanding which sectors are vulnerable can help you make smarter investment choices. It's not just about the headlines, it's about knowing how these trade policies affect real-world risk and opportunities. So what can you do as an investor when tariffs cause market uncertainty? First, stay informed. Keep an eye on trade news and policy changes, because these events can create both risk and opportunities. Next, diversify your portfolio. If you have heavy exposure in sectors like steel, tech, or agriculture, consider balancing your investments with sectors that tend to be more resilient, like consumer staples or healthcare. This way you're less vulnerable to sector-specific shocks. Another strategy, take advantage of market volatility. When tariffs cause short-term drops in the stock market, it might be a good time to pick up quality stocks at a discount. Focus on companies with strong fundamentals and a proven ability to weather economic storms. Lastly, consider using hedging strategies, such as investing in ETFs that track a broad index, like the SPY. That reduces your risk. These tactics can help smooth out the bumps in these turbulent times. To sum it up, tariffs have a profound impact on the stock market, hitting sectors like steel, tech, agriculture, and automotive industries the hardest, while others like consumer staples, utilities, and healthcare remain more resilient. By understanding these dynamics and adjusting your investment strategy accordingly, you can better navigate market volatility and protect your assets. If you found this video helpful, please hit that like button, subscribe, and share your thoughts in the comments. How have tariffs impacted your investments? What sectors do you think will emerge stronger? Let's talk about it. Thanks for watching, and remember, staying informed is your best defense in a changing market. As always, I'm gonna catch you in the next video. Peace.